Chapter 13, we talk about credit risk. The first section just covers general credit risk that really any consumer should kind of be comfortable understanding. So there's 5 C's of credit. They're character, capacity, capital, collateral, and conditions. So character is basically just your credit worthiness, and a lot of times businesses can determine that based on your credit score, which we'll talk about in the next section. Capacity is your ability to pay the bills. So what's your income compared to your expenses, which we'll talk a little bit about that in a future section also. Capital is more like how much equity do you have, like your assets compared to your liabilities. Do you have a lot of equity and paid off assets? Collateral is, can the bank use some of those assets as collateral? So if you're getting a car loan, that car would be collateral. If it's a mortgage, your house would be the collateral. And then we have conditions, and those are more based on what's going on in the economic climate at that moment. So is there craziness going on like the coronavirus? Is there an economic downturn, or is everything up and everybody's doing great? So then the next section does talk about credit scores in your credit report. So there's different agencies that you can get that credit report from, and all consumers can have one free credit report each year, so you can see what is on that report and what your credit score is. Obviously, the higher the credit score, the better. The lower the credit score, the worse. So if you have a higher credit score, you should be able to get bank loans and credit cards. The lower the credit score, you might be able to still get them, but you're probably going to pay a higher interest rate. We have how the banks determine your sufficient income. So they could look at your fixed payments to say what's your monthly income compared to what your fixed payments are, like your mortgage payment, your rent payment, things that don't change, that they know for certain you have to pay each year. And that should be about 35%. So out of your income, 35% of those could go to your mortgage or your rent, and those types of payments. Car loans, student loans, all those things kind of fit into that. Then your debt to income approach would say to look at your debt payments compared to your income, and that shouldn't be more than 20%. So then that's another ratio that they could look at. Then they talk about what other types of risks. So those are more consumer related. What more are related to businesses? So a lot of banks specialize in their lending, so they may loan to specific industries. So like maybe retailers or restaurants or small businesses or big businesses. So that's considered specialized lending. Then banks need to understand the business's cash flows, because some businesses are seasonal. Some businesses have cash flow that doesn't come in at the exact same time every month, you know what I mean? And a lot of times that's what hurts businesses. So if the bank can understand that and help them through that, that is a helpful relationship. Then there is secondary sources of repayment, like what can the businesses have that the bank could fall back on. So they too can have assets that they can use as collateral. Sometimes the bank will ask for compensating balances. So if they get a loan, they have to maintain like 10% of that amount in their checking account or their savings account at that bank. Or there could be personal guarantees so that the owner is then going to vouch that in case something happens to the business, they would be liable for it. Obviously, businesses need to be closely monitored to see like how they're using that line of credit. A lot of times banks will make sure that the business is able to pay that line of credit off at some point in time during the year, take it down to zero. And then geographical diversification. Sometimes those, based on the region of our country, we can have different economic situations going on. So sometimes banks are nationwide and cover all of those, and sometimes they don't. So interest rates, the rate that goes along, or I'm sorry, the risk that goes along with interest rates is basically that it changes. So an interest rate risk is the chance that the value of an asset will change because of change in interest rates. So say, for instance, bonds. Bonds will, the value themselves, what they will sell for today will change depending on what the interest rates are, because bonds pay interest normally annually, could be semi-annually, and then people are willing to buy those bonds to receive the interest. So what they look at is what is our current rate of interest compared to what those bonds pay. So that can change the price, but that can do that to other assets. Bonds are just a good example of that. Then it gets into just, again, interest rate risk in general when you're a bank, because from a bank standpoint, they're making money off of the interest that they're receiving when they loan that money out. But some of those loans, like we know, are more long-term. So we have car loans that go 5 years or 6 years. We have mortgages that go 15 years or 30 years. So those rates are normally fixed. So that money's coming into them. Then they are paying interest on all the deposits that they have in the accounts, the CDs, and then those are more variable. I mean, they're fixed over a period of time, but not near as long as our loans are. So sometimes that's the risk, is that if they have these long-term fixed rates that are low and people are locked into those in their loans, and then all of a sudden the interest rates change, market changes, people need more interest in their CDs or their deposits, then that goes up. That's an expense or a cost to them. So that they give you the little formula that the interest rate spread is the interest rate income, which would be coming in from those bank loans, minus the interest rate on the deposits that they have to pay. So they want that gap to be significant. They want more money coming in on those loans than they're paying out. And normally, I mean, from my standpoint as a consumer, normally that's the case. I'm normally paying a higher rate of interest on my loans than I'm getting in my savings. But every once in a while, they'll run specials on those CDs. And those rates are normally pretty good. Okay, then they talk about a gap analysis. So our interest rate gap analysis is the difference between the amount of assets and the amount of liabilities on which interest rates are due. So again, like I'm saying, you're comparing the loans to the deposits, and they would want that gap to be positive and larger. You know what I mean? They want to make sure that their income coming in is higher than the expenses going out. And then it talks about duration analysis. I'm not really going to have anything. That formula is a little more complex. But just the definition of it is that it's the measurement of the life of a bond or any debt instrument. And it can be, the measurement is sensitivity of the price to the bond change to the interest rate change. So like I said, that bond price is in business finance and in accounting classes, we'll calculate that bond price, but the bond price is based on what it is paying in interest compared to what the market of other bonds is paying. And again, if it pays a higher rate than market, the bond price is going to go up. If it pays a lower rate than market, the bond price is going to go down. So that price does fluctuate based on the bond itself, and then the length of the bond also, how long the bond goes can impact that. Then it talks about reducing the interest rate risk. So if they can match those assets and liabilities from a standpoint of the same maturity level, which would be hard, I feel like, because the loans are so long-term. Our CDs are never normally that long-term. Or if they could try to get more adjustable rate loans, because then those aren't fixed. You know, if you get a mortgage and it's fixed for 30 years and it's at 3.5%, I mean, that's what it is for 30 years. And of course, during those 30 years, interest rates are going to change. Businesses are normally given variable rate loans. So every quarter they'll change. So then if the interest rates go up, the interest rate charge on that loan goes up. And they've tried in past years to do some variable mortgages, or with a variable arm. So like for 10 years, it's a variable rate and then it goes into a fixed rate. Some of those are a little riskier. So consumers tend to steer away from those, but businesses do get the variable rates. And if you have home equity loans, those are normally variable rates because you're not really getting it's more of a line of credit. So it's like you have access to this money and you're not getting it today. So you're not locking into a rate. That too will change normally monthly, I think. Then there's interest rate derivative contracts. So those are ways that they can kind of lock in to rates. So that derivative market again is more of a high finance topic, but they could go out and find other banks or other financial institutions that are willing to enter into this derivative contract with them. So they could say, I've got so many millions of dollars that I want at this interest rate. So it kind of takes away the variable for a certain period of time. So like for 90 days or for 6 months or whatever. And then, so in a sense, they're locking into that rate during that time. And then where they make money or lose money is if the interest rate changes. Okay, then our next section, we talk about liquidity risk. So liquidity is basically the business's ability to turn assets over into cash and to be able to pay their short-term obligations when they come due. So all businesses worry about liquidity. Banks are definitely going to be a little bit more worried about it because, like I said, they could have these long-term loans that are not liquid. Do you know what I mean? You can't get me to pay my car loan off any quicker. And then they have a ton of liquid liabilities. So like if I go in and say, I want to take all the money out of my checking account today, they can't stop me. So, you know what I mean? So that's where the liquidity mismatch is, that these loans are long-term and all of the demand deposit accounts that they hold. If we all went in today and got our money, the bank would be in trouble. So that's the liquidity risk. So sources of liquidity, the primary reserves is just their cash in the vault. So that is not going to be a ton of money and not going to be, but that is completely liquid because it is cash. Then their secondary reserves would be the treasury bills or the federal funds that they hold. Then it would go into bank loans. But again, the only thing that makes those a little bit more liquid is if they could sell them. So I don't know if you've ever had a mortgage or even sometimes student loans are sold, but those they can group up and sell them and get cash right away if they need to. So even though you as the consumer, the person with the loan, you're not going to have to change anything other than who you pay it to. The bank gets their money right away. So then other solutions to a lack of liquidity, so they don't have liquidity and they've already tried to, get these federal funds or sell their mortgages. They could borrow more from the Fed. They could try to increase their deposits. And I do think that that's what banks have done recently, is try to increase those deposits. And I think that's like what Wells Fargo got into trouble for, because they're pushing their tellers or their associates to increase their accounts. So like if you're already a customer there, they want you to open a savings account, or they want you to take money out of another bank and put it into a CD because they give these great offers. And they really were pushing those tellers to do it, which in a way is trying to increase those deposits. Now, some of them were then figuring out ways to do it fraudulently without the customers even knowing they were opening new accounts and things like that. But I think that's ultimately was the goal, was to increase the deposits, even though it got a little bit out of hand. They could sell any of their liquid assets, which again, they could issue commercial paper, which is like kind of a loan that the bank is taking from consumers. I never feel like it's very common, but I'm sure it does happen. And then there's the securitization of assets. So that is when they sell those mortgages or they sell those student loans. So they'll normally group them to get a large amount of money and then sell them to another bank. So that's called securitization of assets. Oops, sorry. So then we talk about how much liquidity is enough. So again, because liquidity is an issue, how safe do the banks need to be? So the liquidity coverage ratio is the ratio of their liquid assets compared to their net cash outflows. And they would want that to be, they have a net stable funding ratio that says it's the proportion of the bank's long-term assets funded by stable long-term sources, which include customers' deposits, long-term bank borrowing, and the bank's capital. So there's not really a formula for that, but they just have to feel comfortable that they've got enough to cover it. Then we get into the other risks category. So they have operational risks. I mean, because banks are businesses, so just like any other business out there, they've got operational risks. And that's the risk that they are not going to have adequate internal processes, to handle the business and to cover their expenses as they come due and all that type of thing. Then we have foreign exchange and country risk. So that is really kind of unique to banks. It can also impact international businesses. But the foreign exchange would say, like, how's the US dollar doing in comparison to foreign currencies like the euro or the Japanese yen or whatever it is. And as that US dollar either increases in value or decreases in value, that can impact the bank's holdings, and those changes can impact their profitability. Then there's market risk, and that is the risk of loss occurring as a result of a decline of the market value of their assets, which would probably only be if they're holding stocks and bonds. Could be government bonds though, because those they definitely are holding those. So those things do change with the market, like in right now with the coronavirus, the market is dropping. So that is an issue. And there's other, obviously, economic things that happen that make the market drop. And those can impact not only businesses and consumers, but the banks as well. Then the last section deals with bank performance, and it talks about their income statement and their balance sheet. So they've got their interest income. Their net interest income is calculated by taking their gross interest income coming in from those bank loans, mortgages, business loans, all that stuff, subtracting out their interest expense, which is what they're paying out on their deposits and their CDs. And again, like we said, we hope that there's a big gap. So we hope, the banks do, we hope that there's higher income than there is expenses, because again, they're for profit. And then if there is, then that would be their net interest income. But then from that net interest income, we still have to add any non-interest income that the bank has and subtract any non-interest expenses. So the non-interest income is like their bank fees. And a few chapters back, we talked about how they have different bank fees for businesses, commitment fees and they do letters of credit and standby letter of credit, all those things they do for a fee. So those would be non-interest income. And that can be a big chunk of their money if they're a large business bank. Then subtract out their non-interest expenses, which is basically all their general and administrative expenses, the salaries that they have to pay to their employees, the electric bills, the insurance, everything that a business has to do to have brick and mortar facilities as well as online presence. So all those things would be non-interest expense. Then you hope that after you subtract those, the bank is still profitable. Their balance sheet, again, we had that in another chapter because a bank's balance sheet is very unique and different. But what this particular chapter talks about is the return on assets and the return on equity, which are two ratios that are very common to compute. But the return on assets is our net income divided by our total assets. And then return on equity is the net income divided by the equity capital. So those are going to be common ratios that the bank would use to kind of judge their financial positions. And then that is it for chapter 13.